Hello, everybody, and welcome to day 3 of the Financial Cycles Summit, sponsored by the Foundation for the Study of Cycles. It's been a fantastic first 2 days with Sherman McClellan, Larry Williams, Jeffrey Hirsch, and Peter Eliades, and we have another incredible day of conversations with Cycles luminaries, including our first guest, Bill Sarubbi. Bill, thanks so much for joining us.
Thank you for that introduction and your kind invitation.
Yeah, well, we are thrilled to have you, and thrilled to have you as a member of the board of the Foundation for the Study of Cycles. You have been involved with the foundation for a long time.
Since 72.
In 72, and really, you know, I've talked to a lot of people who love cycles, and you're one of the people who really, I would say, has, you know, really made their living on cycles. You know, you, like a lot of people say, yeah, I use cycles, but I use other things, but you use cycles, you know, and, you know, you've held quite a number of extraordinary positions, including, you know, the working with the Abu Dhabi Investment Authority and their investment committee. Interestingly to me, you trained as a therapist originally.
After I got my MBA, I trained as a psychotherapist with Dr. John Barakos, ages 24 to 33.
A psychotherapist, not a cycle therapist?
Psycho.
And would you call yourself a psychotherapist today?
I guess we could invent a new term, yeah.
Yeah, right. Well, it's great to have you, and I know you got a lot to cover, so why don't we just get down to business?
Okay, so I'll share the screen.
And I am going to turn off my video, and I'll be fielding questions over the course of the presentation, asking some of my own questions, and then we'll jump back on for some Q&A towards the end. All right?
Okay, well,
right,
thank you everyone for your attendance today. This is successfully employing cycles in the investment industry. And I have a quote here from Francis Nielsen, one of my favorite historians. In the history of nations, we can no longer ignore the manifestations of cycles and repetition of growth and deterioration. That is very true. I bought a book on technical analysis. I bought my first stock in 1966 when I was 17. I then went off and got a BS and MBA from NYU and got out in 72 just in time to see everything I was taught not work right. There was an old 1960s comedy record from the Firesign Theater. It was called Everything You Know Is Wrong, and that's exactly how I felt. Yet there were people around me making a bunch of monies, trading short and long, and the first thing I said was, what's short? Because of course, being trained at a regular university, you know, you bought stocks and you held them. Hopefully not from 70 to 74 when the market went down to 500, and with the inflation, there was very real wealth destruction. So I started looking for some way to make predictions, and I kept waiting for them to teach us this in graduate school and then in industry, and it just wasn't there. I was a fundamental analyst, a technical analyst. I was in institutional brokerage. Then I went to Abu Dhabi Investment Authority for 13 years, where I ran their technology portfolio, was on the currency hedging committee, and was the North American strategist. And then the last 3 years there, I was in the external management. And since then, I've been on my own from my home in Vienna, Austria. So cycles have benefited me. This is a broad brush look at a number of cycle phenomena, which are each worthy of an individual talk, or certainly for an article in the Cycles magazine, which we will publish in Q4.
Very excited about that.
I'm just explaining how I used each one of these. Each one of these is worthy of a great deal of discussion and analysis. So the cycles are the 1, 4, 10-year cycles in the stock market. Then I have my cycle forecast. I'll explain that when I get to it. Then there's the annual cycle for individual stocks. You can dramatically improve portfolio performance by taking a look at the annual cycle. Then there's the real estate cycle. Then there's Wheeler's war cycle and the panic cycle. Now, when I got out of school, I was at the Value Line Investment Survey, and they said you're paid to make an educated guess. There's no such, we can't predict the future, and that always bothered me. I said, there's got to be some way. And I, for example, met Frankie Joe. Frankie was a Chinese orphan, worked on the floor at Wall Street, decided to show us all how it's done, started a newsletter, which failed. He then, starting with $600, made for himself and Interstate Securities $32 million over 15 years without having a losing year. Wow. And if you asked him how he did it, it was sometimes technical, sometimes fundamental. It was a little of this, a little of that. And I met another guy with a very interesting theory who was leaving Merrill Lynch to set up on his own, Bob Prechter, Elliott Wave theorist. And 2 or 3 blocks from where I lived in New York was George Lindsay, whom I used to meet at coffee houses and yak to. And I do have an article about Lindsay cycles, which will be in the first edition of the Cycles magazine in Q4 this year. That's already written.
So Bill, since you're bringing up Cycles magazine, thank you. Yes. And Bill is going to be the editor, hopefully co-editor, along with Richard Mogi, of a relaunched digital version of Cycles magazine. So very excited about that. And I think we're going to be putting out a call for papers soon, right?
I've already got 5 of them. Andy Pancioli is working with Richard and I also.
Excellent. So
okay, so let me jump down. Cycles are based in human feeling. Great traders like Frankie, the reason I brought his name up, I've got another friend, Alan, 35 years on the Chicago Board of Trade. Alan and Frankie, how do you trade? He said, well, you know, when everybody gets excited, there's a normal level of excitement. When you feel it exceeds that, it's usually a top. When it gets down to a whisper, it's usually a low. You're measuring feelings. Now, NYU graduate school, 1972, I think it was, Professor Martin Gruber. This was a great experience. The final exam, what do you think makes the market move? And how would you go about measuring it? Everyone looked like they had just seen a ghost or a zombie. They didn't know what to write. I was writing like crazy. Gruber had us read all the quantitative studies done in the market. And here, of course, is where I thought we're going to learn how to predict the market with 80%, 90% accuracy. So I concluded that it was based on cycles or waves of feeling. If we had a way to measure that, we would have something. He called me into his office, shook my hand. That was the best paper in the class, the same conclusion he had come to. He's a very well-known, retired now, but one of the honored professors at NYU, was there for a long time with Edwin Elton. Elton's specialty was portfolio management.
Do you still have that paper? Do you still have that paper? The paper that you wrote at NYU.
No, that was the final exam. I handed that in. Then there's the work of George Lindsay. I was at a SIRE meeting, the Society for the Investigation of Recurring Events, which was actually the local offshoot of the foundation. And one evening, somebody said, would you like to share a cab down to the village with me? That's the way George talked. And he wore these glasses that had glass that were thicker than those worn by the late singer Roy Orbison. So when you looked directly at him, his eyes looked huge. And George, of course, wrote a book called The Other History, which nobody reads or pays any attention to. So he also had a big influence on me. Now, specifically, the 1, 4, 10-year cycles. The 1-year or annual cycle is the seasonal cycle. The 4-year cycle is attributed to the central bank supporting the incumbent president. We're supposed to call it the Federal Reserve, but it's really the central bank. The 10-year or decennial pattern of Edgar Lawrence Smith was developed in the 1930s. So the annual cycle, this one I'm sure you all know. The stock market tends to rally in the spring. It tends to top in the summer. The market falls in the autumn. June and September have had the worst returns. The market tends to bottom in October, which usually has been the most volatile months, but it usually closes on the upside, and the largest percentage gains have clustered in October. I was in the NYU library that is on the south side of Washington Square Park back around 1969 or 70, 71, and I pick up a dust-covered volume, the University of Manchester Statistical Journal from 1880, and it had a study of the London bank reserves over the prior 60 years, and it concluded there was, for some reason, there was a tendency for bank reserves to reach a low point in October, Reason? It's an agrarian society. It's not an agrarian society anymore, and we still have lows in October. And Q4 has generated 60% of all profits in the S&P. Now, the 4-year cycle, some Wall Street veterans contend that the Rothschilds were the first to discover and use this cycle for profitable trading. Early in the 1800s, a New York investment group reportedly employed a mathematician to uncover the Rothschild secret. More recently, a gentleman named Verrill L. Dunbar wrote about a 3.8 4-year cycle in the June 30, 1952 issue of Barron's. The cycle has been attributed to central bank action supporting the president in the next election. However, as my late friend Ian Notley, the developer of the Notley Information Service, used to say, there was a 4-year cycle in the numbers prior to the establishment of the Fed in 1913. And the cycle is also evident in countries where there's a 4-year election cycle, a 6-year election cycle, no elections whatsoever. In other words, there's a 4-year cycle. The 10-year cycle developed by Edgar Lawrence Smith at Ameritrust Bank. Years ending in 0 have had the worst returns. So here we are in a year ending in a 0. Years ending in 2 have a tendency to bring market lows. Years ending in 5 have tended to have the best returns. Years ending in 7 have always brought crises, except for 2017, unless there was one we don't know about. Years ending in 8 or 9 usually do not terminate bull markets, which is one of the reasons I stayed positive in years ending in 8 and 9. And my friend over in England, Robin Griffiths, thinks that the basis of this is a 3.3-year economic cycle. 3 times 3.3 is obviously 9.9 or 10. And none of this, of course, none of this is used. If you mention this in any major institution, and I mentioned it many times at ADIU, 1,200 employees. And by the way, they are the largest fund in the world. It's not in Norway. They in the early days, when you could go right up to the top floor and just say hello to everybody, you got all the inside information. You can't do that anymore with the security they have.
I don't know what you can share, but I've enjoyed some of the stories you've told me about the resistance you got to some of these methodologies when you were running institutional money.
Well, the only person who believed me was Ali El Sayed, who was the guy who hired me. When I got there, I found out that he's known as Abu Wahalid. Now, Abu means father, and Abu Wahalid is father of boss of bosses, which is why they couldn't argue with me too much. I actually had my car at roadblocks. The guys with M16s looking for somebody. They would wave me. The captain of the guard would wave me around, salute me, and say, "Have a good night, sir." My wife says, "Who's that?" I said, "I don't know, but they must know I work for Ali." So anyway, you would think that institutions would use most of this stuff, but they don't use any predictive techniques. To me, they look like they are eating soup with a fork most of the time. So every big Wall Street firm wanted out of your business, and so I got to go to all the big institutions and sit and have great lunches in Wall Street with Goldman Sachs, Morgan Stanley, and they don't look at any of this. So here is the 1, 4, and 10-year cycles projection for 2016, and obviously it's clearly labeled. The blue cycle is the annual cycle, hardly changes. The 4-year cycle, again, it's the election year cycle, that hardly changes. And the red one is the 10-year cycle, which most people ignore. And at the bottom is the summation of the 3. It's just vector addition, just the percent change smoothed, and then we add them all together at the bottom. Now, I use this in 2016 as my primary tool. And, you start out over here, and if you see the cycle is working well, you stick with it. My main tool for adhering to the cycle, to confirm it or not confirm it, was the 10-day advanced decline line moving average, or the total. So advances minus declines, 10-day moving average. If it was very high, like up around here, I would take that as a confirmation of the circle. If it got low around the cycle, if it were low, like it was here and here, I would take that as a buy. By the end of the year, I was ranked #1 in market timing by Timer Digest up in Connecticut, which is an independent rating agency. Those were the tools I used. Wow. Now compare this to sitting around a table. At least at the Middle East, you get served an endless flow of very nice tea, espresso, and Turkish coffee. But guys going on and on and on about matters that are totally unrelated to the market.
Yeah.
And one of my friends, This is not an act. I said, I'm doing this, and I'm getting more mileage, than these guys are getting, calls with the best known names on Wall Street at the time.
Yeah.
And I got criticized once by an assistant director for not showing up. I said, well, tell me when the last time that guy was right. What year was it? 1910? I said, the guy's never right. According to him, we should be underweighted in technology. And I'm running the technology end of the portfolio. It's the hottest group in the 90s. So most of their forecasts are forecast. That's the actual S&P 2016. And, most of these forecasts are, they're just, projections. Yesterday, plus 3%. So now here's the 1-4-10-year cycle in 2020. Now, let me explain. These cycles are static. When I say static, I mean that they tend not to change. They change over the years, but there's static and then there's dynamic. And what I do is 51% dynamic. I'm going to show you that in a minute. But I just want you to take a look at that is the 1-4-year, 10-year cycle in 2020. Wow. Now, just looking at this and knowing that years ending in 0 have big market declines, look at this. I mean, I called for a top as early as January 10th, and the actual top was February 19th. It hung up a bit longer than I anticipated. And the low was in the cycle was March 18th. The actual low was March 20th. Wow. Now, March 20th, of course, is very close to the spring equinox, which W.D. Gann made a great deal of. It's a secondary reason that you would pick that date, but instead of the 18th, you pick the 20th. The actual low was Friday the 20th, and by Monday the 23rd, the current rally started. Wow. So now let's go to the next one. This is a dynamic cycle. This comes from my software. That is the monthly cycle projection, and you'll note, see that high? Yes. That was around February. That was around the actual top. You can see the actual top is the heavy black line. Let's go back. Now, does one confirm the other?
Yes.
So that's why I was so certain it'd be a big decline. I have institutional client. They got in touch with me in January. I said, according, to what you're saying, you think the market might be going down? I said, yeah, does it rain in London? Is there sunshine in Abu Dhabi? I said, yes. I said, you've been reading my work. And they said, why are you asking? Is we have 165 million to put into the retirement fund. Should we deploy it in equities now? I said, absolutely not. Wow. I said, do it in the 3rd or 4th week of March. They followed my instructions, 30% decline, 30% of 165 million is $55 million.
I guess you got a big check.
Well, no, they're in at the introductory rate, but that only lasts till the end of the year. Yeah. So right now, if you look at it right now, we are in right now, the weekly cycle, which I'm not showing you, is down. We're in option expiration. Option expiration was last month. And option expiration is a bullish month if you look at all 12 months combined, but not in June. So it was up last week, I know, but post OPEX week in June is dreadfully bearish, especially if the market has risen in the month prior. And look what's happening today. All the gains for this week are being wiped out. So here we see the low now. It's coming up in the first week of July. Well, by that time, the weekly cycle will have bottomed, and the end of the month bullish period discovered by my old late friend and mentor, Arthur Merrill, will kick in. So I'll probably be buying tomorrow just to update you. So these are the stock market cycles. And now I'd like to get to something very important in fund management, because when you are given a fund, it's buy and hold. You can't go to cash. And the benchmark is the S&P 500.
Can I just ask you, Bill, how
Sure.
The last chart that you were showing there?
Yeah.
Was that a similar cycles analysis as to what, tech signal uses?
Yes, but this is I designed this program and had it coded.
Okay, but it
same
is
principle.
A Fourier type analysis with a statistical test?
Yes.
Okay.
Yes.
Very good.
So if you hold certain stocks have a very pronounced annual cycle. Here's Ford, and I did this some time ago. That's why it's not updated. This is old software. Here you see this is right in the middle of the screen. That's June 30th. That's January 1. That's December 31. That is the average price from March 1980 to March 2007. So that was 27 years of price data of Ford Motor Company. Seasonally, Ford has rallied from December 14th to June 24th for an average 19% gain. Ford has declined from June 24 to November 11th for an average 5% loss. This translates into buy and hold, which is what we're supposed to do, 6.9% a year, up cycle only 194 days, 35.8% annualized gain, down cycle only minus 13%. Now let me go to a really egregious one, Archer Daniels Midland ADM agricultural firm. Look at this is the annual cycle. Now I just ran this. In other words, this is all prices from 1980 right up into the present. So how many years is that? That's 40 years, 39 years worth of data.
Okay.
If you buy and hold the stock, which is what most of your big pension funds do, which is why they're now underfunded, you get 8% annually. If you own it January through August, you get minus 9%. But if you buy it August through January, 32% annualized.
Oh.
So
Wow.
just to look again at what you had asked me about, when I went to Abu Dhabi, I mean, I actually went into, I said, I'd like a cup of coffee to take away. Yes, sir. Sit down, please. And I said, yeah, I'd like to take the coffee away. So, yes, we'll serve you a cup of coffee, sir. And I said, yeah, but I want to take it away. And the guy says, well, sir, when you leave, you have to leave the cup here. And there was no such thing as takeout coffee.
Uh-huh.
The stores did not accept credit cards. It was cash only. Talk about primitive. I mean, there were no risk controls at the authority. There was nothing. And I got there and the guy said, this is nirvana compared to the way it was when we started out in 77. And so anyway, I could weight these stocks any way I wanted to. And I was doing technology. And as the market ran up, it got more sophisticated. I said, uh-oh, they're going to start importing knuckleheads from New York, which is exactly in London, which is what they did.
Mm-hmm.
So I get a call to go up to this group that's been assembled. They work directly for the managing director of the entire authority. And they're asking me about the transactions in the account. Now, the average cycle for technology as a group is a high around August 15 and a low around October 15. The average high for the year has been computed to be about September 5, and the average low October 27. That's for the overall market. Technology tends to top about 2 weeks earlier than that and bottom about 2 weeks earlier than that. So we had very big gains in Microsoft, Intel, Cisco. I said, gee, I don't want to give any of this back. And I see the annual down cycle coming. What could I do? I looked around and I found under my purview of interest was automatic data processing paychecks. In other words, they're payroll processing, information processing companies with PE ratios of 10 as compared to 30, 40, or 50 of the portfolio. So I would reduce my holdings in Cisco, Microsoft. Now the names are escaping. Cisco, Microsoft, and any of the other big names of the day, Intel. And I would buy these. And they asked me, why you're doing this? And I said, well, and I explained this to them. And I said, well, what's the fundamental reason behind this? And I said, there is no fundamental reason. I said, no, the fundamental reason is called making money for my client. That's the reason. And now, many years later, the technology became available. When during the year is the best time to hold the information processing stocks? You want to guess? August, September, and October. Now, I don't know whether that's created by nature or whether it's other fund managers doing what I was doing, but I shielded the stocks that I was owning. I dropped the weighting. The market declined. I bought them back in the middle of October. So I get told that I can't do this. By the way, if you want a position like that, there are two requirements. The first is a pulse, and the second is never have to manage money any time in your life, and then you qualify for one of these positions to tell us guys what to do. And now I'd like to shift from stocks to the real estate cycle. That is 18 years in length. It breaks down into a 4-7-7-year segment, 4 years, 7 years, and 7 years. There's a 4-year crisis or bottoming phase. We just saw that in So 2007 to 11 or 2008 to 2012. That was the bottom. Then there was a mild 7-year recovery. People are reluctant, of course, after such a shock to buy real estate. So it's a very flat recovery, which you'll say. Moderate price rises. After 7 years, people feel that they've lived now. It's now 4 and 7, it's 11 years. So real estate starts accelerating. That leads to a top. And this is very well outlined in The Secret Life of Banking and Real Estate by my friend in London, Phil Anderson. And Phil credits Fred Harrison in his book, Boom Bust, for tracing history to find the cycle. And this is straight from the book. So this picture tells you everything. This is the 7-year moderate phase. Then there's a little break. And over here, it's, well, real estate hasn't fallen like it did over here. It's not back to its lows. So let's pour into real estate. 7 years up, you hit the top, and down you go for 4 years. 2 years of a crash and 2 years of recovery. I spoke to Phil. Last time I said, we both agreed the next top is probably around here, 2022, 2023. So I think a lot of the money that was in the market, in the paper markets, in other words, bonds and stocks, is flowing out now. It's going into real estate. We both agree that this period down here, this was around 2016, around the time of the presidential election. So probably a shifted administration gave people an added degree of confidence. And we're now nearing the top. We're about 2 to 3 years from this top, which will be followed by a decline.
I look at that chart and I recognize it. It feels very familiar to me, having been through a couple of these cycles.
Well, if you go to Ed Dewey's catalog of cycles, do you know how many 18-year cycles are in there in nature? Tons of them. Yeah. And it's really remarkable. And in fact, the place I'm sitting in, my USA, I live in Vienna most of the time. My USA home is just east of Princeton. And the value, I bought this place in May of 2012, and the price is almost, it's more than tripled. It's almost quadrupled.
Wow.
So that's how valuable it is. So have I used the cycle? Oh, yeah. You know, when I was buying it here, I almost bought some other, and people were saying, are you crazy? Do you want to buy now? And I said, it's going up from here. It's not going lower. So the 18-year cycle
stops in 2022, 2023. That's when.
And that's what Phil and I think. Yeah.
All right. Well, thank you for that.
And the way I interpret this, if I'm speaking to an institution, I say, well, look, what happened over here in 2016? It was an election. So I'm saying, well, the new regime will give people more confidence, and the stock market's going to get a little bit rocky here in 2020. So I'll bet money will flee the market beginning in 2020. It'll go into real estate, and it'll see that little kink there where it really accelerates. I think that's the cause. I mean, I think it's very important to keep in mind that the Federal Reserve is a money-creating corporation to which the government has assigned its powers, which according to the Federalist Papers is illegal. But anyway, 1970-71, NYU, Professor Robert Cavish, who counts as his friends all the Fed chairmen, who said, Professor Cavish, the U.S. has, Nixon has broken the link between gold and the dollar. He said, well, this means you have institutionalized inflation. And what it means for you guys is that rallies will become much more pronounced in the stock market, and declines will be much more dramatic but short-lived. In other words, that monetary policy has created a type of volatile market we're looking at. And in June 1980, of course, Jimmy Carter signed the Monetary Control Act, which says the Fed can monetize anything. It can buy all of our American Express card bills and hold it on their assets, on their balance sheet as an asset, and give us the cash.
Yeah.
So that's creating these wild fluctuations.
A leveraged buyout of the United States.
It is. Now I'd like to move to, I've been studying military history since I was 15, and I used to work for Simulations Publications Incorporated, which published Strategy and Tactics magazine. I think a lot of the fellas out there probably played all those war games created by Jim Dunnigan, who's still a friend of mine, and formerly NBC's commentator on military affairs. Professor Raymond Wheeler of the University of Kansas and his students created two indices, an International Battle Index and a Civil War Battle Index. It runs from about 500 BC up to 1990. It has not been updated. The original one was up to 1950. Richard Mogi got it updated to 90. Now, it is an index of battles, individual battles. It's created. We're trying to get the exact formulation, but at the moment, I know it includes the percentage of population engaged in the battle, the number of countries involved, the collateral damage in constant dollars. Now, how they got that in BC times, I don't know. But the Wheeler's War cycle, I immediately thought to myself, 1870, there were 3 great battles of the Franco-Prussian War. And by the way, the battles were rated a 1 for a little one, a 2 for a medium one, and a 3 for a big one. And I said, there were 3 great battles of the Franco-Prussian War. 3 times 3 is 9. And I looked at that year, 1870, and Wheeler assigned a 10 to that year. So that's roughly how it works.
Okay.
And this is how I used it when running my institutional service. Bill, when you sat through Gulf War I, let's see, I was still in Abu Dhabi at the time. And when do you think this this conflict is going to? No, I had left by this time. I was in Vienna. The 18-year, you see up here, it's an 18-year cycle. Again, there's 18-year cycle and everything. When this cycle is rising, the protagonists get more aggressive. When it tops, somebody loses. It's like getting hit by Mike Tyson. It's losing at a battle, and then the morale collapses, and downhill goes the cycle. In 07, 08, I called Jim Dunnigan, and he said, well, Bill, anytime they overrun an Al-Qaeda outpost, they come up with thumb drives and hard drives that contain lists of all of the safe houses and all of the contacts in different countries. And that is how they won the war. The newspaper never printed this, but they hit them all in different countries in a short time period. And if you went running to a safe house, you found the soldiers already waiting for you. They hit them all at the same time. And that is what caused the peak in fundamental terms. But look at the cycle. The cycle pointed to that year. It's only a question. So a lot of the work I do, the cycles are the skeleton, and my fundamental analysis based on past history, it puts the muscle on the bones. So strong man relaxes. That means, look at the United States. They won a 2-front war in 1945. And in 1950, they couldn't stop the North Korean 1st Tank Division. So the strong man relaxes. The cycle's declining. People feel safe. The aggressors are emboldened enough to begin attacks when the cycle bottoms, and the strong man wins at the cycle peak. So currently, we're in an up move, and that doesn't top till about 2022, 23. And now here you can see cycles plotted. Pay attention to that. You see 18, but you also see 90 and 60. And again, 90 and 60, these are cycles that show up all over the place, as any cycles researcher will tell you. So
you actually have the Wheeler War data?
Sure.
Fantastic.
Doesn't everybody? No.
But it's only current through 1990, but you can still use it to predict.
Oh, you can project it out as long as you like. But, I and Richard have been discussing updating this, and we've been discussing different ways of doing it. And of course, if he can come up with the exact formulation. But meanwhile, I'm thinking he and I were discussing ways of updating this, but you really don't need to. If it goes back to BC times to 1990, I mean, 1990 was only 30 years ago. So.
Yeah, that's a blink of an eye in millennial terms.
So let's move on to panics and financial panics. I was wondering, do panics occur with any regularity? They seem to. In 1902, Professor Theodore Burton described a panic as a prevalent disposition during a brief period in which the real situation, serious perhaps, is made much worse by the general excitement and alarm. We cannot say that under more modern and improved facilities for information and organization, business communities are for a considerable period overcome by a sudden fright or exaggerated alarm. A panic is a sudden fright or an exaggerated alarm. One night in our villa, my wife dropped the frying pan, and our 8 cats went running for different parts of the flat. There was no reason to panic other than a loud noise. And could this be cyclical? So I started in 1600. I went through my entire library, and I coded months. 1 for a normal month and 2 for a panic month. Months were determined to be a panic month simply by extracting the information from financial history or by observing market behavior, especially if there was a collapse in that country's currency. And I had to come up with something like the stock market declined in 1987, as President Reagan said, there's no reason, nothing wrong with the fundamentals. And he was right. If there's a 50% decline in the Dow or the S&P in 31 calendar days, that's a panic month. So since this measure was devised, the cycle peaked within 1 to 2 months of the Cyprus crisis, banking panic in Cyprus, within a month of the potential US government shutdown and the Greek crisis. And I actually got a call from a fund manager client in London. They said, Bill, the Greek crisis, should we be worrying? I said, nope, the cycle peaks now. It peaks at a low level and it's turning down. That's how it helped us out. Now here you see the actual index. And there again, you see the cycles plotted. You see them right here.
Yep.
And it is simply a numeric index. Now, if it gets up to, let me put the glasses on to make sure I got this right. Oh, the cycle level is over here. If it gets up to about 2.5, 2.7, or gets to 3, which is where it was in the 30s, you can get concerned. Here you see a high coming in September 2020. Now remember, it's a year ending in a zero. The panic cycle is rising. That means the tendency of investors to panic over fundamental developments is increasing. That's what it means. And in September 2020, you'll notice it hits a peak. So after that, people are going to be much more relaxed for whatever reason, I don't know. So there should be some sort of a very good low in the fourth quarter, in September or October. When do 60% of all profits occur in the S&P? In Q4. So I can also tell you generally 25% of all panic months have occurred in August and September. Following that is the March through May period. In fact, prior to 1900, March was the outstanding panic month. Now, I guess we had a recurrence or a flashback this year because the market certainly declined severely in March of 2020. Mm-hmm. Next, 31% of all panic months fall in years ending in 7 or 8. Well, remember the decennial pattern?
Yep.
About a third of all panic months have occurred in October and November in years ending in 7 or 8. Following that are years ending in the number 2. And according to the decennial pattern, most bear markets end in years 2, and we begin a new bull market in years ending in 2. Mm-hmm. So 2022. The least panic months fell in years ending in 4 or 6. Now, even if you disbelieve this, at least here you have a distribution. Mm-hmm. So if you are going into in the autumn of year ending in 7 and 8, you've got a 1 in 3 chance. If you simply say there's going to be a panic, you've got about a 1 in 3 chance of being right, which is better than any of the other months. And I was actually with the managing director of the largest insurance company in Austria twice. And there is a market tendency of the bond market to drop in certain months of the year. That's March, June, September, in about the third week. And in the middle of June, I met with him. What do you think of bonds? I said, they're going to get clobbered. 1 year later, he sees me again. What do you think of, it's June again. What do you think of bonds? They're going to get clobbered. I want a consulting agreement. I want this and that. Asking somebody if bonds are going to decline is like asking if there'll be, sunshine in Abu Dhabi and rain in London. It's not a tough one to make. The odds are on your side using the annual cycle of the year alone before you even put in any dynamic cycles. So now we're going to change yet again, since I don't like, it's a real question, not to be too critical of all the researchers out there, but economic projections. Does gross national product really mean anything, or does it really measure anything? And Marty Armstrong did a pretty good job of cutting that apart at a foundation presentation many, many years ago when he had Princeton economics. And so I took the business activity index, which is created again by Ameritrust Bank. Ameritrust Bank is, again, Edgar Lawrence Smith, the decennial pattern. Unfortunately, in 1988, they were taken over. And the first thing you do when you take over such an organization is you get rid of all the creative people. They created a business activity index by going back to 1780 and taking any shred of business activity, GDP, In some years, it was just the railroad stock index, which may have only been 10 stocks. They spliced it all together and they called that the business activity index. It is a histogram that fluctuates around zero. And it is currently kept updated by Richard Mogi and myself. I entered it into my old program back in 1986. And that was back in the days of DOS computers, and younger members of the audience won't remember. Those were the days of steam-powered computers. And the reason this looks so faded is because it was printed on an old Daisy line printer. And I've kept it like you keep an old baseball card, because that is the business activity index, which fluctuates around 100. We've anchored it to 100. So in other words, down here, you're below average. Up here, you're above average slightly. And that is the cycle. And you'll notice it peaked here. And so people were asking me, Bill, well, why? Well, I'm in London. Bill, why should, what is this telling us? And again, this is the skeleton. Here comes the muscle. Well, my family was in building for 90 years here on the East Coast, and I knew all these buildings weren't worth what they were going for. So I said, there'll be a real estate peak. And if there's a real estate peak, it has serious implications because people use most of their wealth is in the increased value of their real estate. If that drops, it's going to hit disposable income, which is exactly what happened. And what I did not appreciate was the severity of it. And when I was at that time was consulting with Shinsei Bank in Japan, and the CIO told me what the numbers were, the leverage and the amount of this bad paper held by the banks, I said, oh, this is going to be far worse than I thought. So then the question is, well, again, great acid testers. You go to London with these dinners with these white-haired old gents with the little mustaches who all look like characters out of the old Sherlock Holmes movies. And they ask very pointed questions. And, they were there. They experienced this. I said, well, young man, what should happen down here? And I said, well, there's probably going to be, at least to be a low. And they said, well, usually the market, the economy bounces back. Why would there be a flat market here for about 8 years? And thinking on my feet, I said, I had done other cycles of politics. And I said, well, it is time for a Democrat to get elected, somebody who's Jimmy Carter-like, who will have trouble with Iran, formerly Persia, and he will be hostile to business, and the rebound will be very limited. And that described the last administration for 8 years. And then, of course, I got the great question, well, why should it take off in 2016? I said, oh, that's the year. This is an easy one. There'll be an election. They'll hire, now, again, using the political cycles, a Reagan-like person who is very friendly to business, and the economy will boom. So that is how I've read this cycle. There's a lot I think you could do with that. Now, in case you're wondering, here are the 6 cycles: 11.9 years, 16.8 years, 16.9, 33.8, 29.4, and 36.4. And again, if you go through the cycles foundation data, or you go look at George Lindsay's book, Lindsay made much of these latter 3 cycles in culture, that's another lecture. But this is far better than what anybody was bringing to us at the Authority or anything I saw on Wall Street. And I used to go, very fresh MBA, right out of school. I'd go to, I lived in Greenwich Village. I wasn't married. I went to every single stock market meeting I could go to and wrote down everything I could, and I was shocked when I found out how low the batting averages were and how inconsistent these projections were. I'd much rather rely on this. And so how am I using that currently? I said, well, it's a year ending in a zero. The market is going to have some sort of a dip or decline somewhere. And there was a 100-year cycle. And there's a little known depression of 1920. Add 1920 to 100, you get 2020. The best source for information is at the von Mises Institute, which is at Auburn University, of which I am a member and take classes. The numbers, do I have this down here? The numbers in that little known depression of 2020 to 2022 were as bad as those as 1848 to 1850 and the 1930 depression. Unemployment went from 4% to nearly 12%, and GDP declined 17%. But the 1920 downturn, like 1848, the government did not do anything. And therefore, people reorganized very quickly, and in 2 years it was over. So 1848 and 1920, you don't hear about 1920 because they don't want to publicize it, because you'll find out that Harding and Coolidge did very little. Harding, of course, I think he died in office. And Coolidge took over, who was known for not doing very much. And reportedly at a Washington dinner, a lady socialite went to him and said, "Mr. President, I bet my girlfriend's over there at the table that I could get you to say more than 3 words." And he said, "You lose." And that was the type of guy Coolidge was. He actually cut the size of government. So I am forecasting 2020 to 2022 a quick recovery, a V-shaped recovery. I've been saying it from the beginning because of my knowledge of this 1920 event, and seeing how quickly an economy can rebound if it is unfettered. Whether it's going to stay that way, I don't know. So, and again, the best source of information, because the Von Mises Institute is a free market institute, they'll tell you the straight story. There are several books in this, but I think they have the best information. Now, why do cycles work? John Nelson, when asked this question, he says, "You want to know?" John was
the radio.
Yeah, I'll tell that story in a minute. He says he's talking to Sire and says, "Mr. Nelson, why does this work?" He says, "You want to know?" He's about 80 years old at the time. "You want to know why it works?" He says, "I don't know why it works. When you get to the pearly gates, you can ask the Grand High Muckety Muck, and he probably don't know either." So that's John Nelson, who worked for the RCA Corporation. They put him on top of a building with a telescope in 49, the year I was born. And they were trying to determine what caused shortwave radio disturbances, because we had obviously no satellites at the time. And he, in his book, I forget I think it's 2 different titles. So one of them is The Propagation Wizard's Handbook. I remember that. And I think it's the same book with 2 different titles. And he looked at the planets, Mercury through, I think it was Mars or Jupiter, because he was looking at gravitational pull, and he got very mixed results. So he decided before he gave up to include all of the planets, even though the gravitational pull is very light from the outer planets, and he got north of 90% accuracy. And even after shortwave radios became obsolete, shortwave communications obsolete due to the development of satellites, he still maintained a newsletter that he wrote that shortwave radio operators bought, because they wanted to know when their transmissions would be disturbed. And what he found out was, when the planets make certain angles, it creates solar activity on the sun. You get solar flares. Those solar flares affect the magnetic field of the Earth. And in 1973 or 4, I was training to be a therapist, and I read about serotonin. And I asked Dr. John Parakos, fully trained MD, psychiatrist, a student of Wilhelm Reich. He and Alexander Lowen developed bioenergetic therapy together. Dress for Success, Blink, all that stuff comes from their work. And I said, "What is serotonin?" And he said, with his Greek accent, "We don't really know yet." But he said, it is a regulator of the body. It regulates the mood. And while it fluctuates with the magnetic field, so mood is altered by the serotonin in the body, which is secreted in the brain. And it has been determined that serotonin is a substance in the brain of a homing pigeon that enables it to home in. In other words, it can detect the magnetic field of the Earth and fly along these lines.
Wow.
So that may be the grand link as to why this stuff works.
That's fascinating. Excellent.
And closing, I'll just say I have this stamped on my, on my at work, my official cycles research documents. A reasonable probability is the only certainty. That's the conclusion that I've come to. If you can guess, and there's an old Wall Street saying, traders used to say, "Bill, if you can get the market right 60% of the time, you can make a fortune." And then I'll throw in from Richard Diamond, who's a trader. I've taken all these trading workshops. Now, Richard is like my friends Frankie Joe and my other friend, Alan Matthew out in Chicago, they've never worked for anybody else. They made all their money trading. They got to know something. And Richard used to say, if you're 100% certain, you're usually wrong. If you're 85% certain, you're usually correct. There needs to be a certain degree of doubt. So forget about 100%, and especially forget about predicting the end of the world for two reasons. First, it never ended, so we don't know what the run-up into it. It never happened before. We don't know what the run-up would look like.
Data points.
And if it does end, none of us will be around to congratulate you on your accurate prediction.
Excellent.
So if there are any questions, I think we have a little time left.
Yeah, Bill, that was amazing. You were right. That could have been 5 presentations, but really appreciate you sharing all this with us. And everybody, this was recorded. It'll be available on YouTube shortly after we finish up this evening. We will spend some time unpacking this in future weeks and months, I'm sure. I would actually like to go back a little bit and just make sure that, that I understand things. So if you could go back to slide 8 first, which is the 1-4-10-year cycle slide.
Yes.
Yeah. So these are essentially seasonal cycles, right?
That's it.
So it's the average behavior of that cycle for that year, right?
It's the 1 year cycle is just the average movement during the year for all years. I think using that program, I think the daily date is 1885 to the present. Okay. And let me just say, yes, the market closed in 1918 at the outbreak of World War I for 8 months. And they formulated a new index. And if you read Arthur Merrill's book, Behavior of Prices on Wall Street, which is one of the great books that inspired me, you'll see that he points this out, and he gives you a factor. It's like 0.6 something something, about 6 decimal places. If you take that number and you multiply it times the data from 1885 to 1917, it becomes comparable to the subsequent data. And what I did in the old days of Lotus spreadsheet, if you remember that, I assumed a straight line extrapolation between where the market ended where it closed at World War I's outbreak. For those 8 months, a straight line extrapolation after adjusting the earlier data to comport with the subsequent data. That's how I got it. But somebody out there was thinking, wait a minute, the market was closed in 1918 for 8 months. So that's how I did that.
And then,
was it 1914? I don't remember.
An equal weighting of those 3 cycles, add them together?
It's just percentage change. It's vector addition. In other words, if one of these cycles is up, 5%, and another one up, 10%. It's the addition of the two. Yeah. And if one of them is down 3%, you deduct 3, and you come up with a net. It's simple percentage change added together, which I understand is called vector addition.
Are you concerned at all about the quantitative easing and everything that the Fed is doing to disrupt these cycles?
Yeah, well, some wise man once said, currencies don't float; they merely sink at different rates. And back in the old days, we discussed with Professors Kavish and also with Professor Myron Levine at NYU. Mm-hmm. And we said, well, what does this mean in the future? And it's my economics professor was Greek. He says, great idea. Give everybody in the country $100,000 a year guaranteed income. Mm-hmm. Bread will be $50 a loaf, but everybody will have $100,000. And that money sloshes around in the system. And these are called Cantillon effects, named after Richard Cantillon, who is a mysterious Scottish economist and philosopher who pointed out if the king issues too much money, it goes to all his cronies first, which made him a marked man immediately. Mm-hmm. And so it depends where the money's going. And I talked to graduate students at MIT, Stevens Institute, NYU, Rutgers, Princeton, and Stevens. And I tell them, if you could determine a way, because the question is there going to be more money, more credit, or less? It's not a question of whether there's going to be credit issued. Yeah. And I said, they'll stop issuing credit when governments start spending. And I said to the crowd in Abu Dhabi, you'll see that when camels learn to fly. And they said they expected to see the sky filled with camels before we see this. And, so it's just credit that flows out. And I suggested this, I'd like to get this in closing, was I told them, I said, if you could find a way to figure out where all this, with cycles, where all this credit is going to flow. And remember, during the prior administration, the money supply doubled. Well, it's got to go somewhere. It does not, it disappears in a deflation. And there's a great book in defense of deflation, which you can get from the von Mises Institute. I took this to the university in Austria, and you would thought I brought a crucifix to a vampire convention. They said, how could you be reading a book like that? I said, guys, look at all the evils of inflation. I said, it's only a question of whether, for example, let's just say that artwork is 2% of all investable funds. I'm making this up. If it goes to 4%, does that mean you should start selling your artwork? I mean, how, if stocks are 30% of all investable funds, I think the bond market is bigger. It's probably stocks, bonds, real estate, collectibles, art. If you could determine what percent those are of the, where can money go? Well, it's only going to go into those areas. Where else would it go? Mm-hmm. And in other words, if it gets up to be very high, there are some very good indices like housing prices versus gold. Like if housing prices get outrageously high, it's usually high in inflation hedges. So yes, the only question is, Felix Zulauf, a very successful European fund manager, came to my villa in Abu Dhabi in 2000. And I said, there's going to be a big sell-off in the stock market. Year ending in zero, year 2000. It's got to go somewhere. And Felix and I agreed it's going to go into gold and energy and commodities because it's just going from one asset class, disintermediating into another. And if you can figure that in advance, you're going to end up riding around in steaks and eating Cadillacs.
So, and then if you go 2 slides more,
yep.
that is showing us kind of your 1-4-10 forecast for the year right there, right?
Yeah, but here's my other forecast. So now,
okay,
this is a static cycle. These are dynamic cycles. Up to this point, they've both been right. And so I have to make a decision here. The closer we get to Q4, the happier I feel. And how far away are we? July, August, September?
Yep.
We only have to get, so my word is that, I would just stay right now. I'm staying fully invested. Oh, and very important, how do we know this was just a correction in a bull market? Because it came down in 3 waves. This is ABC. And when we got to the bottom, anyway, I can't get the point.
I'm going to take one moment and let our next speaker into our meeting here. So give me just 1 second.
Okay.
Perry Kaufman is joining us.
Oh,
I don't know if you guys know each other, but Perry, I don't know if you can hear me. Bill and I are just finishing up, but we're looking forward to talking with you in just a few minutes. Yeah, so you're seeing some tension between these 2 cycles forecasts right now for the next few months.
That's the challenge. You see, people who want to get interested in this, young students, I tell them it's not a panacea. You wind up having to choose. Sometimes you get, 3 indicators pointing up and 3 down, which every technician faces that, but it works that way with cycles too.
And then can you go, let's see, to the real estate panic cycle?
Well, the real estate's not a panic. It's real estate cycle. Did I go past it?
I think you did go past it. Where was it?
Right here.
Okay. So we got some comments in the thread saying that the peak was probably more around 2025, 26.
Okay.
Do you have any idea how we can follow this real estate cycle? Because this seems very important.
How to follow it? Yeah, you look at the rate of acceleration in property, and if it gets unreasonable, yeah. I lived in Houston very briefly in 1980 when that cycle peaked, and you had like a friend says his mother is in. I said, what kind of trouble is she in? You mentioned she took out a mortgage on the house she's in, and she bought another house just to flip it. And some guy who designed, his name is Harry, he was very artistic, designed 1 house at a time. He says, well, but so fortunate the real estate market. Why don't I do 8, development of 8? He filed for bankruptcy. He got caught in that oil price decline in Houston. That was a localized real estate panic. You have to look at the fundamentals.
Yeah. All right. Well, Bill,
Okay.
we have used up our time. If you can stop sharing your screen and we can,
I can stop sharing.
Turn our
my
video
screen.
back on for just a minute.
How's that?
Good. Can you turn your video on too? So we can just sign off.
It's saying you cannot start your video because the host has stopped it.
You know what? That's probably my,
Yeah.
I turned it off earlier. So there you go. Try now.
There we are.
Good. All right. Well, that was fantastic. And you and I do talk on a weekly basis at the board meeting. So I'm going to be asking a few more questions of you next time we talk and making sure I can get back with answers to everybody's question. But that was phenomenal.
And I just want to remind the listeners, I will be exploring these in the journal.
Yes.
And so,
yeah, very
and
excited
future
about
lectures.
that. And I don't know if you will take this the right way, but you know, I enjoy your stories about how smart people, you know, screw things up. I find your work to be offensively simple.
Well, that's a good. I'm going to use that. That's very good.
It is. It's offensively simple. You know, like we all want to think we're so smart, right? But when you see the kind of patterns that you see and they make money over and over again, you know, it's all those managers, they got to be able to pretend like they know what they're doing, that it's not that simple, right? But yet what you've shown me over and over again is that it really is that simple. And, you know, a sign of intelligence is actually doing something simple that works, right? Not being able to make up fancy explanations that make you look smart, but end up not working. So I thank you for that.
Oh, thank you.
All right. Well, I know you got some big events ahead of you, but let's catch up in July and follow up. Yeah.
Now I'll stop sharing and.
Okay. And everybody, you can learn
I'll
more.
Stop my video and you can bring Perry on.
At cyclesresearch.com. Fantastic. Thank you so much, Bill.
Okay.
All right. Perry, are you there? Can you hear me?
I can hear you. Can you hear me now?
Yes, sir. We're good. Welcome. I don't know if you can turn on your camera and just say hello.
I can do that.
There you go.
Oops, let me point this towards me. I'm not using any high definition anything.
You put on a collared shirt for
I did. Well, I had just come back from exercising before.
Oh, excellent. Well, we just had a great conversation with Bill Sarubbi. And just want to remind everybody that we are the Foundation for the Study of Cycles, cycles.org. And if you're not a member, we'd love to have you join as members. And we're at the halfway point now for what's been an incredible week of incredible speakers. And I know we are drinking from the fire hose. And this presentation is going to be no different, I'm sure. In fact, I asked you to even share a few advanced things with us, Perry, that I know we're trying to squeeze in at the end. But like I said, this is all incredible content that we're going to be, you know, unpacking over the next few months. And we're looking for the common threads that we're seeing across everybody's work. So, Perry.
Oh, well, when you find the common thread, please let me know.
Thank you so much. I actually have been enjoying one of your books here.
Oh my God.
Reading.
It's
I've
a
owned
bit
for a
old.
long time and has actually been very influential for me. So I was like, wait a minute, is it that Perry Kaufman? And it's like, yep, that's him. So we are thrilled to have you with us. I'm a systems guy, you know, and I know you are too. And and your website is Kaufman Signals?
Correct.
KaufmanSignals.com, right? And
yes.
You've been at this for a while?
I have been at this for probably as long as you've been alive.
I'm not sure. I'm older than I look, but you've been kind of taking the engineering approach from the beginning?
Oh, yes. Well, if you know any of my background, I worked,
I mean, you were literally a rocket scientist, right?
I was a rocket scientist. We did the navigation for Gemini.
Wow.
So,
That
which
qualifies as a rocket scientist.
it does, but compared to the tools we have now, we did that with a 4K word onboard computer.
Mm-hmm.
You have no idea how small 4K is.
Yeah, 4K. I thought, wow, that's a fancy monitor, but you're talking about the actual
It's
computer,
not
right?
even it's not even a fancy monitor.
Yeah.
So,
Yeah.
but it was fun. You're young, you do this stuff. It is really exciting.
Yep. And how did you get interested in cycles?
Well, cycles are just part of technical analysis,
Mm-hmm.
you know. And when I look at cycles, most often I look at seasonals and yearly events because I feel that they are the strongest, least variable, you know, type of cycles. So they're more seasonals. Presidential cycles are yearly. I like them. I have no trouble dealing with them. When it comes to Kondratiev waves, which are, could be plus or minus 5 years, I find that not quite tuned to my trading.
Not quite as impactful and effective.
Yeah, a little difficult to apply to day-to-day trading.
Yeah.
So,
And you're still active in the markets today.
oh, I'm quite active. I manage money. I trade myself every day.
Yeah.
So you can't really do this if you're not in touch with the market.
Yeah.
And the more you watch the market, you get ideas for something new.
Yep. Well, I would love to get into your presentation and share what you've got to share with the audience.
Okay, if I can figure out how to do it, we'll
So just at the
we,
bottom of the screen there, share
we can.
screen.
Okay, then I have to pick the right one, so we're not looking at the
Yes.
wrong monitor. So
I think it
I'll
was
give that a
Matt.
try. I'll still be able to hear you, I assume. You'll tell
Yes,
me if I.
yes, I will be here, and I'll be feeding you some questions and asking you questions, interrupting you every once in a while.
Oh, wonderful. So let me see if I can get this up.
Sure, take your time.
I have screen one.
I think it was screen one that was the slideshow last time.
I think so. It's not screen two. Did I? Oh, share. I have to press the share button.
There you go. And I'm going to turn off my video. That's perfect. And I think you should turn off your video too, just so we can focus on the slides, and then we can come back and
well, what I do is I see Zoom here instead of.
I can turn off your video.
Wait a second. I'm
Yep, we're good.
Okay, I'm going to start. Everybody hang in.
Yeah,
Okay, you see a picture of me? I think that's wonderful.
got it.
Okay,
Look great.
Okay. And this is my topic. I'm going to talk a little about seasonality. And then I had a special request from Richard to do some portfolio risk techniques, which I think you'll find particularly interesting because I consider them probably amongst the most valuable things that I do.
It's my favorite topic,
Oh,
personally.
good. And I think
Not
it's really
everybody else
important.
will be as excited, but I'm really looking forward to it.
Yeah, I think people spend a lot of time on the strategies and often forget how important risk is. And also in this case, I'm going to talk about stock selection, which is also important because you have a system and you have hundreds and hundreds of stocks, and you have to be able to pick which ones you want in your portfolio unless you're able to buy them all. Unfortunately, I'm not that wealthy. So
I haven't found that to be very effective either.
No, but then I could just buy the index. And I think we can do better stock picking, especially in this market now that is so volatile. It's incredible.
Yep.
Here's a disclaimer. Let me just summarize. It says, don't believe anything I say. It does bring up a very interesting point. People that make presentations, not me necessarily, tend to pick very good examples.
Yeah.
And you have to really take what's presented to you and try it yourself to really understand whether it works or doesn't work. People are very accepting when they get somebody that has a lot of experience that gives them a system. They don't all work. They work under special circumstances. So it's just a warning that you really need to check these things out yourself. Except for my stuff. I'm very honest about everything.
Larry Williams.
Okay, so this is about seasonality. We'll go through. There's a lot of stuff I'm going to cover very quickly. Most of you will understand it, so it's not going to be a surprise, but just so you know, at the very end, there's an email. You can send me an email. I will send a copy of this presentation to you so you don't have to sit there scribbling and trying to remember any of these charts and tables and patterns. These are the things I'm going to talk about, some agricultural items, some seasonality in stocks, the famous January effect, my after January effect, Christmas rally, what funds do in terms of making patterns in the market because of their buying and selling, they're redeeming, and they're entering into the market for IRAs, the presidential cycle, and then we'll discuss stock picking and risk control in the portfolio.
Great.
At the end. Okay, now a lot of this goes back to Jake. We don't want to cause any problems for Jake, but you know, he started out by doing he started out with seasonality and doing seasonal patterns, and they were really very good. And he was the person that set the ground rules for doing it. And there are a couple of ways to determine seasonal patterns. The most popular way, or the way Jake did it, was to do the average of the months. And so I did a little table here for something. Corn. This is corn. I should have said it on this page. I say it on the next page. And so these are the averages. But what I prefer is something a little simpler, which is along the bottom. What's the percentage of months that the market was up over these years? So along the bottom, you can see for January, corn was up 70% of the time. February, it was up 80%. March, up 80%. I don't like these very precise averages because I just think it's more than the market will actually bear. I like to go with simpler numbers. So 70%, 80%, 80% is good for me, and up 2.2% for that month, I don't really believe. You know, they vary so much that I think you ought to keep your ideas simpler than that. And so on this chart, I'm just showing you the difference in the one on the left, which is using averages, and the one on the right, just using the percentage of years that it was up or down. And they come out pretty much the same. Percentage of years, I think, is a lot easier. Okay, now let's look at, there are some stocks that are clearly seasonal. You know, I find resort hotels, airlines, a number of other things. And I wanted to show you the long-term pattern for the, or long-term pattern. I think this goes, I should have said how far back it goes. I think this goes back to 1998. I think it's 20 years. And the long-term pattern is in blue, and you'll see that it does go down mostly at the first part of the year and up in the second part of the year. And in 2020, so far through May, I didn't do, oh, we're still in June, so I didn't do that. We have this gigantic sell-off in March, not so much in April, not so much in May. And in my opinion, it's possible that we will start getting right back on track by the end of the year. Mm-hmm. Now, of course, if we see another surge in the virus, that may not happen. And even if the airlines still post negative numbers, I think we're going to still see the same seasonal pattern. That if people fly, they're going to fly in the same pattern. They'll fly more in the holidays and in the late part of the summer, early part of the fall, as business starts to pick up again. Mm-hmm. So I think we'll see the same pattern, even if it's certainly not as strong as normal years. Delta Airlines, much the same, just to show it's not limited to one. But Delta seems to have a stronger pattern towards the end of the year. And I see no reason why this wouldn't continue, even as I said, if it's a less of a loss rather than an outright profit.
Sure.
So let's go to wheat, because I started my career in commodities. So I always have a tendency towards agricultural products. And you see, again, we are likely to have much the same product. 2020 is this gray bar that takes a big drop, which is an interesting point. It shows you that during a crisis, almost nothing is immune. You could say, why would wheat go down the same as airlines, the same as other things? And the answer is that it's money that moves the market. And in times of crisis, people move their money out of the market and into other assets, or they take money out of one market in order to cover losses in another. So in all cases, it's the movement of money. And that's why everything turns out to be correlated in a crisis. It's all a function of the movement of money.
And it's risk tolerance too, don't you think? You get nervous and you don't want to lose, and any market is speculative to one degree or another.
Oh, yes. Yes, in 2008, a lot of people exited their positions because the market was down 50%. They didn't want to lose the rest of their money. So when you hear these commentators that say, if you'd only held on in 2008, you would have all your money back and more. Well, it's a bit unrealistic. You know, Nobody
Easier
wants
said
to
than
hold
done.
on. Yeah, you don't want to hold on when you're losing 50% of your money. Or in the internet bubble that ended in 2000, where NASDAQ declined like 85%. Who would hold on to that in
Yeah,
order to make it back 20 years later?
a rare breed, for sure.
Little unrealistic. So just to summarize those charts, trading can be risky. You must all know that by now. And this year it's exceptionally risky. But it also may be a time of opportunity. It could be that, in fact, buying these airlines at extreme lows, I don't know if they're extreme lows anymore, would have been an interesting opportunity. I would not run out and buy the cruise lines at the moment. But I think you'll see a lot of these coming back into pattern, even if they're negative. So now I have a little strategy to go along with this. It may seem interesting that when we look at those seasonal charts at the very beginning, we really look at it from the point of bullishness. We really want to buy in order to make money on the upside. But it turns out that for the agricultural products, because of their fabulous technology, they make the crops better, bigger every year. When you hear these stories about droughts in the far west or droughts in the southwest, it turns out that most years they wind up with a bumper crop because they've engineered hybrid corn, hybrid seed of all sorts to do well no matter what. So as soon as they have their first rain after the drought, all of a sudden the crop looks absolutely fabulous. So most years, grains are bearish. And so I have this little strategy that says, if at the end of January, because we're assuming a normal northern hemisphere crop, which is basically a summer crop, even though we harvest wheat in May because the big crop is winter wheat, which is planted in the fall after the others. Sorry if I ramble on. I was in this business for a while. Anyway, the strategy is that if the price at the end of January is 20% greater than the 5-year average, all right, then you sell wheat at the end of January and cover it at the end of December. So the price is higher than normal. You can expect wheat to decline all year. And it doesn't matter that there's some sort of a drought or a scare or too much rain in the spring. It always winds up being lower, or 80% of the time it winds up being lower. So that's my strategy.
Would you call that a cycle?
It's a seasonal pattern is a cycle.
Pattern, yeah. So you've detected that, I mean, you have a macro thesis that farming's gotten better. And
yes, it
so
has.
there's always a bearish kind of tendency in the grains because crops are getting better and better, right?
Yes, they are. In fact, I found in most of the studies that I do, I try to make money on the long side as well by buying when prices are well below their 5-year average before planting. But it's not as reliable as counting on a bear market.
Got it. In grains specifically.
In grains, very specifically.
Got it.
So
very good. Thanks.
So people should look at it if they want diversification. There's not enough concentration spent on the grains, which are just a great market.
Yeah. And diversification, which we'll probably get to later in terms of correlations in your own portfolio, right? So if you can be short something,
maybe I think you're talking your own portfolio here. I think.
Yeah. All right.
Yeah, we all like diversification, and it's important. You don't want to be stuck in the same sector and everything, because your risk is clearly going to be higher. Yep. But that's not what we're going to discuss later. So, okay, now we're going to talk about the presidential cycle. I hope Lincoln is politically correct. All of a sudden, they may be tearing down his statue. I'm not sure.
I think he's escaped so far. Yes,
good. The presidential cycle is interesting. It was never what I really thought. This chart shows you longer term and shorter term, what the pattern was. And the patterns really haven't changed all that much. They're getting worse you can see in 2020, they're quite erratic, but before that, they are getting less extreme in the first and second years. See, the first year used to be very good, and in 2020, for the 2020 election, you remember that when Trump was elected, the first year was fabulous. Second year, not so good. Normally, the first, second, third year is good because the market's generally good. We have to remember that the market is biased to the upside. So you would generally expect these years to be positive. This year is not so good. You can see on the very far right so far, when I did this a month ago, it was not looking so good. So the question is, how is this year going to end? And I think we all know that it should end better than it is now. And that's probably as much as I can say. I just thought it would be interesting for everybody to see this long-term pattern broken down, and let them decide whether there's something there, because later this year, people are certainly going to be betting on the outcome of the presidential, the outcome of the presidential race.
Why did you break it up into 1984 to 2016 versus 1912 to 1992?
That's a good question. I'm not sure I can really answer that. Maybe it was convenience.
Okay. Something started happening in 84 that you felt warranted a different cluster?
Well, the S&P, if I may have used this with the S&P, and I think the S&P started trading in 83.
Good.
So I would have had to have used the Dow. 1912 to 1992 would have been the Dow. I don't think I wanted to mix them together.
Okay, interesting.
So it was just convenience of data.
And the green bars aren't literally all 2020. It's 2017, 2018, 2019, and then election year being 2020, right?
No, oh yes, I'm sorry, you're absolutely right.
Okay.
It's the most recent election period.
Right.
Yes, thank you for pointing that out. Another little oversight on my presentation. But the colors are,
sure I understand.
Yes, so. The colors are nice.
They are very nice.
Okay, so now we're going to look at Christmas, my favorite Christmas tree here. And Christmas has actually been really interesting. The December returns tend to be strong because people are coming out of Thanksgiving, and there's a lot of shopping after Thanksgiving. The week after is kind of the start of the Christmas season. So I did December in general, as opposed to just the second half. And you can see on the left, the returns from 1950 are pretty good. There are very few years in which December was poor. And when you look at the more recent periods, 1998, the last 20 years on the right, they were also quite good. Small losses, generally steady profits. What happened in 2018? We had a really big sell-off in December. Remember that?
I do remember that. Yep.
I think
remember it well.
30%.
It was a tough month.
It was a tough month, but it stands out as an odd month. And of course, I think 2002 was the end of the big sell-off from the dot-com bubble.
Mm-hmm.
But December is an interesting month. And again, I'm just updating the cycles for the people to consider whether December is going to be a buyer's market or not. I think it will be. Again, we have this caveat that says, well, if this coronavirus comes back with a vengeance, no, it won't be so good. But if these keep going as they are, I would expect a positive December, although not an outstanding one.
Mm-hmm. Okay.
I'm sure everybody will draw their own conclusion, mostly the same. Now, I think this is interesting. Not the cars in the snow. I really don't like winters as much as I did when I was younger. But it turns out that the January effect was supposed to be up in January, up for the rest of the year. Well, it turns out that January is inconsistent, but the rest of the year is quite consistent. And so I took January out of the year. And these results on the left show what the rest of the year is without January. And of course, the stock market is biased to the upside. So it's going to look pretty reliable. And it turns out that if you eliminate January, which is less reliable, and you start trading the beginning of February, then you're likely to have a much better return for the year.
Interesting.
Yeah, I thought it seems silly to say up in January, up for the rest of the year. Just nothing is that predictable.
That's not what you're saying, right? You're saying January is unpredictable.
Yes.
Take it out.
And then then what you see,
better year.
Yeah, what you see on the left is the rest of the year.
So do you have a chart showing just January?
Do I have a chart? Yes, I do. Is that the next chart?
I don't
know. Okay, this is January. Oh no, it's this is the average changes for the month, which shows you that February is actually quite good. January, if this was the change for January, shows that it was actually slightly negative. All right, it shows the average was less than 0.5%. And then February was positive. March was very positive. April was neutral. Oh, no, I'm sorry. That means April also had a 2% return. And then after that, it had a poor summer. And in October, it recovered. And October, November, December were positive.
Mm-hmm.
So this, I guess there was probably something to the sell in May and go away until the end of September.
Do you know what period, how many years this included in this average?
This is 20 years.
20 years. Okay, got it.
Up on the top, I say not very since 2000.
Got it.
So, and in the second spot, I say for the past 20 years.
Yep, there it is. September doesn't look too good either.
No, it doesn't. October is really quite good. And then these other months, November, December, are also, even though it looks like it's coming down, it's just not as good as October, but it still shows better than a 1% return for those 2 months. So the summers are erratic. People aren't here, they go away. Things do happen in the summer, but there seriously are people that are not interested in trading during the summer. So,
Yep.
okay. Now there is something that you might not think about much, which are what I call fund flows. And it turns out that there's a lot of money that comes into the market from 401ks, company retirement plans, and people take money out for obvious reasons. As you get older, you're required to take money out, or you need it to buy a house, or you need something. So the question was, is there a pattern to when this money comes in and when the money goes out? What I did was I looked at a pattern in TLT, which are the long-term bonds, and then I looked at a pattern in SPY, obviously the major index. And what I did was I aligned the first day of the months and the last day of the months. So you'll see on the bottom of the chart, 1, 2, 3, going up from the left, that's taking every month, and you don't want to align it by January 1st, February 1st, March 1st, because one could be on a weekend. So these are really aligning the trading days of the month.
So the average of day 1, the average of day 2, the average of day 3.
Right. And then I started from the end of the month.
Yep.
And that's where I have -1, -2 from the end of the month. Mm-hmm. So we can see the third day from the end of the month, the fourth day from the end of the month. And that seemed to me the way to show whether there was a pattern. Mm-hmm. And you see on the left, this is 10 years, 2010, 2019. You'll see the end of the month for bonds were buying opportunities. That for the last 9 days of the month, the returns in bonds were all positive, but the first 9 days of the month, they were mostly negative. Mm-hmm. I find there is a distinct pattern there. I don't know if it's driven entirely by the funds, but I expect so, because I don't think individual investors would have caused a pattern like that. Mm-hmm. Yeah. They may have caused a pattern by moving average buy signals could occur at any time, or chart patterns. In 2020 on the right, there is still a negative pattern in the middle, but you see the pattern on the right, which was so dominant in the past 10 years, seems to be not negative, but not really there. Maybe it's that people are not putting their money into funds, so there's not a real big investment this year to move the money, to move the market up. That would be my only guess, that people are not putting money into these funds.
Still looks more positive than the first half of the month.
Well, actually, the first half of the month looks okay. Yeah. It may just show this
in -10.
Yeah, you have to remember that interest rates have come down this year.
Yeah.
And so any buying of futures, mm-hmm. which would reflect the same thing as TLT, would show that people are buying interest rates. Maybe they bought bonds and sold futures, or sold the index, which we'll get to see now, because we're going to go and see what happened in the stock market. So this is the pattern of on the left, the last 10 years of SPY by day during the month. And you can see that now you've got the first half of the month generally positive, and the last few days of the month positive. And of course, it's all skewed because the market was very strong, 2010 to 2019, a serious bull market. So you would expect some positive patterns here. All right, now you look at this year, and of course, we're dominated by a very big sell-off. And I think that's the only conclusion you can make in 2020, is that it reflects a lot of people getting out of the market.
Mm-hmm.
So
Yeah.
just taking one more.
Way of looking at the data.
Sorry, a little drink of water there. Okay, so it's just that at some point, probably 2021, this pattern on the left for bonds and for the S&P will probably start again. I mean, we're going to get back to normal at some point. People are going to put money back in the market. They won't be scared of what's going on. So I put this out there so you can see what the normal pattern is going to be, and we should be back there at some point. And that's all I've done on the seasonal aspects. If you call,
do you use those in your day-to-day trading and fund management?
No. I'm
Right.
interested in them.
Yes.
I do some other stuff, but I am basic. Well, I have a number of systems myself, mostly trend following.
Mm-hmm.
But the things that I'm going to show you now are an integral part of what I do.
Yeah.
And I think they're quite important. And they apply not only to trend following, but I also do timing methods, buying pullbacks. I do divergence. I do a number of short-term programs. Every one of them is benefited by this portfolio risk control,
Yep.
or controlling volatility, and then by selection. You can select futures, you can select stocks. You can do it exactly the same way, whether it's equities or futures. And that's why I really like them, because the methods are very robust. So
absolutely, and I'm so glad that we have an opportunity for you to share this, because I agree, this is really the most important stuff.
yes. So the other was all interesting, and I like seasonality, but the time frame involved in it's too long for me.
Mm-hmm.
So,
Right.
but I do think
shorter term trading.
Yeah, I do think it offers tremendous diversification for people.
Yep.
So
great. So listen
okay,
up.
so
This is important stuff coming up here.
Okay, so let's do this. First, I believe in equal weighting. I don't know if anybody remembers a book put out some years ago called Inside the Black Box.
Nope.
It discussed how the big players handle their portfolios.
Mm-hmm.
And they had optimizations, they had a whole, maybe 10 different approaches to building a portfolio. And the author explained why each one had serious faults. But when he did equal weighting, he didn't say anything about the faults. He just omitted it. And the reason is that equal weighting is the most sensible approach to stock trading or building a portfolio. If you choose cap weighting, or if you put more money on any one stock
Mm-hmm.
that you have in your portfolio, that stock has to outperform every other stock by the amount of the weighting that you gave it.
Mm-hmm.
And I don't see how anybody can figure that out. I mean, I can say that.
Fascinating article that I read about, I don't know if it was Markowitz or, one of the guys who, basically invented cap weighting, right?
Well, Markowitz did efficient market theory.
Right. But, definitely it wasn't equal weighting, right? But in his own portfolio, just Well, I just use 1/n, I use equal weighting.
Yeah, well, the attributes of equal weighting, and I have taken various sectors. I wrote an article on you take a sector like healthcare, and you take the biggest 10 stocks and you equally weight them instead of cap weighting them, and they outperform the index by a gigantic amount with
Yeah,
less risk.
that's fascinating. It's so interesting to me, Perry, literally being a rocket scientist, you could, you could do optimization, more than most people, let's say, but it seems like you keep coming back to not over optimizing things.
Oh, yes. You make a very good point. People have to opt for simpler approaches and understand why they're using these simpler approaches.
Mm-hmm.
And in this example, and in the next one about portfolio or stock selection, you'll see the simpler approach is far better than anything else. I did this, Markowitz was famous for this mean variance portfolio optimization. And
Right.
I did the same thing using genetic algorithms. And I was actually able to come up with a more optimal portfolio. It,
Okay.
but, but it doesn't work. It's
I mean, it
it's
doesn't. It
so,
only works in the back tests. It doesn't
yeah,
work in reality.
it's so overfitted. You
Yeah.
know, again, what happens is when you allocate more money to a particular stock or futures market, you must have that market outperform the others. Otherwise, all you've done is added the risk.
So, folks,
So,
I can't tell you how important this is. You're literally hearing it from a rocket scientist who could optimize. He can literally run genetic algorithms to optimize his portfolio, but he's chosen not to. So anytime you're about to buy another system that promises an optimized approach to the markets, buyer beware, because even the
yes.
rocket scientist doesn't do it.
Yeah. And I have to say, and I don't normally like saying bad things about brokerage firms, but
Yeah.
it used, well, it used to, and they have changed because many firms now just charge a fixed fee for the year so that it doesn't matter how often they trade.
Mm-hmm.
You're not penalized for getting in and out of the market. But it used to be that they would rebalance their portfolio regularly using optimization.
Yeah.
And optimization didn't work, but it certainly generated commissions. So
Yeah.
so I'm really pleased that most brokerage firms have gone away from commissions in favor of management at some small percentage.
Mm-hmm.
Makes much more sense.
I think it's
Favors the
also better psychologically and behaviorally to not
oh,
opt.
absolutely. I think it's really fair.
Yeah.
So I mean, you do have to pay for good management,
Yep.
and this is a much better way to do it.
Very good.
Anyway, so going back to equally weighting, and this equally weighting will permeate the entire portfolio, and I'll show you in a minute. But there there are there are sophisticated ways to do equal weighting, and some of uh, the serious algorithmic traders like to do it by measuring the daily change in risk of each of the stocks and trying to balance out that daily change in risk in some dollar amount. And that would be nice, but it really means changing your portfolio balancing too often.
Mm-hmm.
And it turns out that if you just if you have a portfolio of 10 stocks, say you have $100,000 and 10 stocks, you simply divide your 100,000 by 10 and you allocate 10,000 to each stock. And you do it by dividing the $10,000 by the price of the stock. Now, it's really not correct. It's not bad. It turns out that stocks under $10 are very volatile.
Mm-hmm.
You know, the whole idea of dividing by the price is making the assumption that as the price gets higher, the stock gets more volatile. And it's actually not true. The stock gets less volatile.
Mm-hmm.
The size of the price move gets bigger because at a high price, you get bigger swings, but the percentage of the swing is not as big. So it turns out that the relationship is actually the opposite.
Yep.
But as long as you don't trade stocks under $10, because under $10 it gets outrageous. When Bank of America was at $5, it could make a 50-cent move. That's 10%.
Yep.
So you need to avoid that. But if you go over $10, it's close enough. We called it in aerospace close enough for government work. It's not great, but it's so much easier than trying to take the sophisticated approach that I recommend that you just stick with dividing your total investment by the number of stocks you have, and then your position size is simply the amount of money divided by the price of the stock.
Mm-hmm.
You do need to remember most of the systems that show you how much money you make compound the returns. And when you compound the returns, what you're doing is when you make more money, you're investing it all the time. So you have to be careful. If you have a good run in the market and your 100,000 goes up to 120,000, you now need to assume that you have $12,000 in each stock, not 10,000. So when you divide your investment by the share price, you're dividing 12,000. You have to keep using all your money. Whenever you see excess money in your account,
Mm-hmm.
it means that you're going to return less than you should because you're not getting any return on that excess money. So keep it in mind. If you lose money, you reduce your position size. If you make money, you increase your position size.
Do you rebalance annually typically, or?
No, I just do it when I have a new position.
Okay.
So
have you ever looked into volatility-based position sizing?
For futures, and I'll show you that in a few minutes.
Okay.
Works really well for futures, but it's just too complicated for stocks.
Mm-hmm. Okay.
And as I said, you'd have to rebalance. You'd be changing every time you added one stock and took out another. You'd have to rebalance the portfolio. It's just messy. So again, I opt for the simpler approach. Okay, so
found the simpler approach to actually produce better results, not just be simpler.
Well, it produces better results than the general market. I can't actually. I can say I did volatility parity, which is what you call
risk parity.
The other approach, and it turned out in the long run, it did not do any better. Maybe a little worse than the approach that I'm taking.
Okay.
So it doesn't buy you anything. Just remember, don't trade stocks under $10. They're outrageously volatile.
All right.
Now, at the bottom of this slide, I say that to get volatility parity, which we use for futures, you allocate the equal dollar amount to each futures market, and then you divide by the dollar value of the 20-day average true range. And I hope everybody, does everybody here know what the average true range is? I hope so.
Probably not. We have
okay.
a diverse audience.
It's similar to the average range of the day, very similar, except when you get a gap opening, you treat the average range from the previous close, so that it is truly a more volatile day.
Yep.
All right, that's the only difference.
Okay. So otherwise, it's average range, but you include the gaps.
Exactly. And if anybody wants to know, they can just type in average true range into Google and it'll show them.
So an
So
equal
let's go.
allocation to each commodity market.
I'm
And
sorry.
I'm just following the position sizing here. An equal allocation.
Yes, you take your total investment and you divide it by either the number of stocks or the number of futures markets so that they all have equal amounts of money. And now we're going to try to equalize that amount of money with the position size so they all have equal volatility. And equal volatility means equal risk.
Got it.
Okay, well, I'm glad you've got it. I hope everybody else does. But seriously, at the end, there is an email to reach me. And if anyone has questions, I'll send them a PDF of this presentation. And if they have a specific question, I do answer questions promptly, especially now that we're confined indoors. So,
Yes.
okay, so let's go. So let me just talk about this stabilization, volatility stabilization, because now we've allocated equally to each market as best as possible. But now we get the results of a portfolio. All right. And what happens is, even though you allocate it equally, all of a sudden the market starts to do great. Certain things run up, and you've turned your $100,000 into 150,000, but your volatility is gigantic. And you see, even now, I find the volatility in the market quite high. And so what you want to do is say, okay, I'm comfortable with what we call 12% volatility. 12% volatility means you take the standard deviation of your daily returns, and one standard deviation is 12%.
Over what period of time? A year?
Well, you should do it for a fairly long period of time. If you have trading results, you should do it for, I'd say you should do it for 10 years.
Okay.
Otherwise, you're getting results that are distorted by a bull market. You need to cover a period that includes bull markets and bear markets and a couple of price shocks. And you want to do it either with a new system that you're trying to test out and go back and do it for the whole period, or if you have a good history of your own performance and want to keep track of that, it's even more important to stabilize your own performance.
Yep.
Okay, so, and I know as a fact that people that start trading decide at the beginning that they trade a certain size because they're comfortable with the risk, but all of a sudden the market starts to get more volatile and they're not comfortable with the risk. And this is a way to keep that risk level the same, so you're always comfortable. And it turns out there are some serious benefits from doing it, not just feeling comfortable about the risk, but it will improve your returns.
Yeah.
So let me just go through it quickly.
Great.
Or not so quickly, as the case may be. What we do is we have a daily return in percentage. And I don't normally read my own slides, but I don't want to get ahead of myself here. And we're deciding what the target volatility is, which is 12%. 12% is pretty normal. If you're a conservative investor, then you want one standard deviation of your daily returns to be closer to 8%. If you're very aggressive, you want it to be closer to 16%, but 16%, the risk goes up pretty fast.
Is 12% about what the S&P 500 is?
I'd have to look. I really don't know.
Okay. All right.
But 12% is pretty standard for the futures industry.
Okay.
Uh,
And
And
I didn't realize we're actually at 6 o'clock, and we can keep going. But if anybody does need to leave, I just want you to know that we are recording this and it'll be available on YouTube shortly after we finish up today. So we'll keep going.
yeah, I think we have about
live stream, and so
yeah, I think we have about 10 minutes to go.
Okay, great.
So all these interruptions by you.
Yes,
so,
sorry about that.
Anyway, so the 12% is actually one standard deviation of your daily returns. Okay, and the principle behind this is when the standard deviation is greater than 12%, we scale down our position to 12%. So if it's 15%, we're essentially scaling it down by 20%, which really means cutting your position size by that amount. And if your volatility is less than 12%, you need to scale it up to 12%. And that turns out to be even more important. And the reason is, if you're trading stocks, now I know it's hard to scale up. You can buy leverage. You can do it easily in futures, because in futures, normally you only trade 35 or 40% of the money you have invested, and you leave the rest as reserves. So it's very easy to scale back up and trade a larger position. Not so much in stocks, but I want you to know this anyway. If you're trading stocks and your returns are and your return, one standard deviation of your returns is 6%, half of your target, it really means you're making only half of the amount of money that you would like to be making. And so when you're all done with your system trading, and your system made 50%, and the volatility in your portfolio was only 6% instead of 12%, you're only going to have half the return that you expected. Mm-hmm. And that's going to be very, very disappointing. So it turns out, and we'll go to the next slide, it turns out that an unadjusted portfolio, and this was a futures portfolio, and I have the numbers on the top there, an unadjusted futures portfolio had an average volatility of 10.8%, which, let's see, and that's on the left. But you see that there are a lot of spikes in it, and erratic movement. So you're going to have the portfolio up to 35% volatility sometime, and then down to 5% quite a lot. When it's stabilized at 12%, it actually winds up being 15%. And the reason is because the market makes money. The performance keeps getting better, or your returns get better. You're always pulling it back from a higher volatility. And so the market gets up to 16% volatility, you pull it back to 12. It gets up to 16, you pull it back to 12. So the average turns out to be 15%. And you'll see that I drew a line where it's much more stable. Now, then I actually have a spreadsheet here that shows you some of the calculations. And if one of the attendees is really interested, I can send them a spreadsheet that actually does the calculations, and they can figure it out themselves. But you'll have to request that. But let me show you the results. The results on the left are the 12% volatility, a portfolio which intended to be 12% volatility with no stabilization. It had a 1,600 point NAV when it was done with this 20 years. When you do volatility stabilization, it doesn't eliminate all of the volatility, but you see how much smoother it is. And now the NAV is 7,000. So the return of the original portfolio was 8.7%. The return of the stabilized portfolio is 14%, and it's entirely due to raising the low volatility.
We're going to have you back to talk about this another time in a little more
Well,
detail, Gary, because, you know,
we're all done,
4x
actually.
is very compelling. And
Yeah.
really, it's the same positions, right? It's just targeting a certain level of volatility in your portfolio.
It is. Oh, I didn't get a chance to talk about stock selection.
Yeah, no, I wasn't trying to run you out of the room. I was just saying that is very important, and I want to have you back and talk about it in more depth sometime.
Okay.
Yeah, sorry.
Oh, I thought you were throwing me out.
No, I'm saying that's very important.
Okay. Well, we did that part. So let's go on. And let's just do a little, this is the last section. It's on stock selection. This is one of my favorite pictures. It looks like me on a down day. Now, is somebody talking in the background?
I don't know, actually.
That's okay. I'll just ignore it.
Yep.
Anyway, in stock selection, it's very interesting. Remember, I did say already that I reject stocks under $10 because of their unusual volatility. The key here in stock selection is to run each stock through your strategy and get your performance for that particular stock. We're not talking about how well a stock does in the market in a buy and hold situation. We're talking about how well the stock does on your system, how well the futures market does on your system. And then what I do is I look at it over the past 6 months and over the past 2 years, and I average those together. So I'm looking for a stock that does reasonably well on the system over a period of time. And then what I do is I simply rank them. I just sort all of the stocks by their performance over that short period of time.
Okay.
And some of you may choose to use even a shorter period of time. I can tell you, even shorter might be better. And so you sort them, and then you just trade the 10 best stocks that perform on your system. Okay? And the reason is persistence. It turns out that companies that are doing well continue to do well. Not all companies work well on a particular system. You know, I have a long-term trend following system that I use for this. And so you want stocks that have a trend. But companies like Amazon, companies like Apple just persist beyond what we consider reasonable. They just continue to go up.
Yep.
Now, if you sort the stocks by how they perform on your system, they will generally continue to perform well. Now, the interesting thing is that I resort them every day. And so even though, and I pick the top 10, but if one of them drops to the 15th place, I get rid of it and I replace it with the next highest one that's not being used.
Mm-hmm.
And the reason I do 15 is I don't want the one in position 10, which is Amazon here, to fall to position 11 and have to switch it out. It'd be switching in and out every day. So I have to give it certain latitude.
Right.
You may find that 3 positions are enough. You may find that 5 positions is not enough. You can slow down the switching or speed up the switching by this gray area of how long you'll wait before you switch it out.
Okay.
But I find 5 has worked very nicely. But you may find it a bit more complicated to have to run a bunch of stocks. I run 375 stocks, and they're qualified because I have a little program that tells me how trending these stocks are. And I do that with what I call my efficiency ratio, which I'll let you look up some other time.
Okay.
But I don't want a stock that just flops around doing nothing. I want a stock that's exhibited some sort of trend because I have a trending system. If you have a mean reverting system, you want a stock that doesn't exhibit trending qualities. So you do need to qualify them to some degree. But in any event, I run them every day. I sort them. I pick the top 10. Now, as I said, the nice thing about it is that a long-term trend following system holds a trade a long time. And at the end of the trend, it gives up a gigantic amount. By using this sorting method and picking the top 10, a company like Tesla, which has fallen out of the portfolio, can fall out even though the trend is still long because some other stock is performing much better. And so instead of being in the portfolio for 30 trading days or 40 trading days, it's now in the portfolio about 18 trading days, just because it's kicked out because it's not as good as something else. So that's now, again, the criteria for this was profits only. Now, a lot of you will say, well, I want profits, but I don't want something that has a lot of risk. So you use some sort of ratio of profits to risk. It doesn't work. The more you qualify the performance, the less chance you have of it working in the future.
Wow.
It's just unfortunate. You can't confine the performance. The market flops around.
Yeah.
The only thing we're interested in is whether or not it made money and whether it persisted in making money.
So what you just said is something that you could like tape to your monitor. The more you qualify performance, the less it's going to work. Is that what you said?
I did.
and going back, like I said, you're a guy who could do quite a bit of performance qualifying, but through your decades of experience in the markets, you found it doesn't work.
Well, I did do it. I mean, I'm not saying this because it was simpler. I'm saying it because it works the best.
It works the best. So that it's very compelling to me, Perry, because I'm a numbers guy. I would love to make complex models, optimize things, run genetic algorithms. But I believe you. I've seen it myself, and I just think it's a really important point, and it's great to hear you validating that.
Well, unfortunately, it's not trivial to be able to run the system and sort it by performance.
Yeah.
And so, I'm not giving away the easy solution.
Right.
Somebody that's building a system has to really consider how they would implement something like this. I am fortunate that I grew up programming, and so I could do this all myself in a programming language.
Yep. All right.
So,
very good.
But it's conceptually very simple. It's not quite so easy to make it happen. So, okay, so there we are. I actually did it. This is my company.
Yep.
I have a website, and there's one of my books. This book came. What's that?
The 6th edition.
6, yes. Oh my God, people
Not
were
that
willing
many
to.
books get their 6th edition.
Yes.
Yeah.
Now, you see on the bottom, if you write to kaufmansignals@gmail.com,
Okay.
I will get it.
Great.
And I'm happy to send you a copy of the presentation. Also, you might note that this month I'm going to publish an ebook. I have no idea whether anybody cares about it, but it's really for beginning to intermediate traders. And it talks about things like we've just talked about with examples and how to build systems from the beginning.
Very good.
So,
Well, thank you so much, Perry. Really appreciate you joining us. And I know I asked you to basically give 2 presentations in one. So, but I hope everybody can see the value that I see in this. And I'd love to have you back and talk about it again when we have a little more time, because I think
okay, a pleasure.
is immensely important, and you do a fantastic job.
Okay, well, thank you all for being here. I hope you enjoyed it, and I take it we're not going to do questions.
I think we're going to wrap it up, especially because my tech support, the magnificent Lars, is in.
Glass of wine,
Yes.
so I guess I'm done.
Yes. Thank you, Perry.
Okay.
Thank you so much. And thank you, everybody. And please remember to go to cycles.org and become a member, make a donation, help us bring great cycles leaders and content to you every day. Appreciate it, Perry. Good night, everybody.
Okay, I'm going to sign off if I can figure out how to do that.
I'll sign you off.
Oh.